Good afternoon, everyone. My name is Todd Jones. I'm the Chief Investment Officer of Gratus Capital. Thanks for joining us today for the October edition of Market Matters. Just by way of reference, this is going to be a little bit of a different Market Matters, and we'll continue to move this direction going forward. For every Market Matters after the quarter end, what we're going to do is turn that into really a quarterly market outlook webcast. And that's going to be in lieu of um, that's going to be in lieu of a written publication for the time being. So we hope you enjoy this format. And from here, uh, let me just see if I can get this screen to fit the right way, and we'll be good to go. Okay, so we should be good to go from here. Had some sizing issues with Zoom. Just by way of reference, uh, as you know, we're targeting between 30-35 minutes, which is the typical length of these webcasts. If you do have any questions, please feel free to lob those in the chat feature of Zoom. And as we go along, I'm going to try to pick those out and answer them as they come in. And if it's something that I can't address at the time being, then I'll follow up with you with a separate message if it's an important question. And it's probably one that's on other people's minds. We might even set around a publication to follow. So by way of agenda, here's just our loose agenda, and this will probably take us all the time that we have today to get through. So first piece of this is going to be a look back at what happened in the third quarter, which is the quarter that just ended September 30th. We're going to take a look ahead at Q4 and beyond, which would stretch, of course, into 2021, sorry, and then some portfolio positioning implications that might go along with that outlook. So with that, let's get started. As far as Q3 goes, so I just basically broke the same chart I've been showing the last 6 months or so down into the 3 quarterly intervals here. And what you can see here, Q3 starting this dashed line and July 1st forward, was that by and large it was a very positive quarter for most risk assets. Risk assets meaning things that have some sort of market risk attached to them. Large cap U.S. stocks, this is the S&P 500, was up almost 9%. Which is a very nice return, pretty unusual for one quarter. The emerging markets index was up almost 10%. That kind of makes sense to me, given the significant underperformance. So there's a little bit of a catch up in Q3. Developed market stocks, that's stocks out of Europe, Australia, and the Far East, Japan. Those perform less, not as well, with a 5% showing. And then small cap stocks, just the category of stocks that really can't seem to find a buyer right now, up around 5%, although down, importantly, down for the year, almost 10%. And you can see for the year where we sit with the S&P up 5.5%, emerging markets just off slightly, maybe 1% or so at this point, developed international stocks down 7%, and then of course, small cap down 9 to 10%. I say all that to mention, and we'll touch on this more in the positioning, but large cap U.S. companies remained throughout the quarter our main exposure in our equity sleeve. And not only U.S., but there's really not much else outside of U.S. large cap within that exposure. And that's certainly, I think, worked to our benefit, not only this year, but also in years past. And we'll talk also about maybe some of the subsector positioning here next. Looking at the fixed income markets, again, similar view, year-to-date picture with broken out by quarter. You can see the investment grade bond index was up around 2%. Aggregate bond index was up 62 basis points, 0.62. Emerging markets bonds were up 2.3%, and high yield or junk bonds were up almost 5%. And you can see, of course, over the course of the year how that has evolved with a very substantial drawdown, not only in emerging markets bonds, but also in junk bond markets. And this is one reason why I think recognizing the volatility, I think, is important within some of these higher yielding asset categories. And that's going to be an important message, I think, to take away from this as to why we certainly don't like high yield bonds at this juncture, and we still don't, and what it would likely take to get us into a high yield position. And we'll talk more about that later. But we do like emerging markets, generally speaking, dollar bonds, because the yields are generally 200 to 300 basis points higher. We've not added to that position in our portfolios yet, because I think there still might be some shakeout to come with the dollar dynamics going on right now in international markets. So we're still waiting for an entry point, but it might be a way to add income to the bond sleeve at some point down the road. Another piece that I think we do have to recognize for Q3 and also for the year-to-date picture is what you see on the screen in front of you. So the red line is showing you the performance of the Russell 1000 Growth Index, which just in Q3 posted a return of 13.2%, and the Russell 1000 Value Index, the blue line here, which posted a positive return in Q3 of 5.5%, but for the year still down around 11%. So this, year-to-date picture of plus 24 on the Russell 1000 Growth and a negative 11 on the Russell 1000 Value, is creating some really unique opportunities, I think, to be an active investor. And we'll talk about more what that means as well too. But also recognizing when might be a chance or an opportunity to what they call rotate back into the value segment. And we do a lot of thinking about this because this dynamic right here has actually been one of the reasons why we have had such good performance within our equity sleeve this year, recognizing that, growth companies by and large stood, a much better chance in this opportunity, in this current environment to have good performance versus the old value companies, which tend to be more relating to the economy and GDP growth in the economy. So recognizing what's going to change this dynamic, I think, is really difficult to arrive at, but we have some thoughts on that. And so far, I think we've been pretty right. And this is a chart I thought I haven't shown this in a while, but just giving you a sense for, how different sectors, like under the surface, how has the S&P been doing? And it can't always be just, tech being the answer here of, what's going on. Because, the sector performance tells a really, interesting picture. And it's important to understand, what these sector performances are telling you. And this is just for reference, Stan Druckenmiller, he runs the Duquesne family office of Soros fame. He actually uses sector level performance as one of his leading indicators as to where to allocate capital. But there's a few observations here. One is, as I noted here in this gray box, that the difference between the best performing sector and the worst performing sector is at roughly about 76 percentage points difference. That is a monumental difference. And I think creeping up on some of the widest, 9-month performance differentials that I've ever come across. But you can see what led the market up to a 5.5% return this year. Well, it was technology, of course, at a 29% year-to-date gain. Healthcare, which, as you all know, we still like very much. We also like tech as well. Consumer discretionary, this is a bit more of a puzzle piece potentially, but it does make sense in that, there are certain segments of the economy, which I'll show in a second, that are still spending pretty mightily. And then, of course, you get a few other things that aren't, just kind of treading right along. Staples, which makes sense, I think. Materials, communications. And what hasn't worked, of course, the big one being energy, because energy prices are very closely tied to growth in the economy. Financials, again, another sector that's not done well at all. Now, it's interesting, the best performing position and the worst performing position within financials, as I mentioned maybe a few segments ago, is really wide. So for example, Morgan Stanley, it's a position within our dividend strategy that's actually got positive performance this year. And one of the poor performing financials this year has been Bank of America, and it's down 33%, I think, through Q3. So really important to understand the drivers of return within this segment. But the GDP tied industries, industrials and utilities, even REITs for that matter, have all not performed well and have negative returns attached to them. And I think this dynamic, as I say in the header, sets up really well for active management, which it certainly has so far this year. So here are just some notes, some observations from Q3, and then we'll move into Q4. For, generally speaking, what we've been doing across Q3 is we have been using this broad-based recovery to increase our quote-unquote dry powder in accounts via an ultra short bond ETF, and I've been mentioning this over the last few months, but I think that's just the right answer to be ready for opportunities when they come up because volatility is rising. We did adjust our core equity strategies a little bit within the US and benchmark international strategies. And really all we did was for any of the index positions that we had that were value oriented, we basically converted those from value indexes to dividend growth indexes, because we do believe that dividend growth as a factor or as an indicator indicates value much better than maybe a low price to book or a low price to earnings ratio, because cash flow dividends are one of those things you just can't fake, which is what value indexes sometimes have a hard time with, is the accounting of value and book value and things of that nature. And then of course sector dynamics, as I just mentioned, are creating really good opportunities in active management, and I think for those that are clients, you'll see that in spades in a few parts of your accounts right now. Fixed income, yields are anticipating more QE. I think that's just the message, and certainly Jay Powell this morning in some comments to I think it was the National Economics Bureau, mentioned that there's no reason to think that rates would be materially higher for any in the immediate future because of the deflationary impacts of COVID. So yields will likely be headed a little bit lower potentially from here and anchored by the Federal Reserve and their monetary policy. And I think investors are really, over the last quarter, really glommed onto those words. There still is, on the alternative side, a significant amount of skepticism and some alternative strategies that we do follow, which we don't have much exposure to. One of them being master limited partnerships. Those are down, I think, those are the pipeline companies. Kinder Morgan is an example of a company in that sector. Those companies are down on average about 50%, which is a really large drawdown. Real estate investment trusts, or REITs, I think there's still a big question mark right now as to what's going to happen within the REIT space, given there's such a large, given that there's such a large exposure to the office sector. And then finally, commodities, while they have recovered in the last this quarter, they still remain down pretty mightily for the year. And so what is that telling you? Well, the recovery is starting to be priced in by commodities a little bit, but I think the deflationary aspects of what just happened with COVID means that the demand for broad-based commodities is going to be lower for the foreseeable future. So let's turn to the look ahead here. This should look pretty familiar to you. Not a whole lot of changes have occurred here over the past few weeks or months, but you can still see where we have our exposures and what we find attractive versus unattractive. And I guess don't let this picture fool you in that there are things to do in the investment world. You just have to be very mindful about how you're taking your positions and where you're putting capital and allocating capital, and when it's time to be more cautious. So I think what this might be telling you is that we still think on the US side, large companies tend to be the only area we want to be invested in right now. Developed markets have gotten incrementally better from a valuation perspective, but we're still looking for that catalyst to add to them in any more meaningful way. Same with emerging markets. Government bonds are less attractive than both corporate bonds and municipal bonds, but again, we're talking about on a relative way, not necessarily in absolute terms. And then of course, private markets, we still think there's quite a bit of opportunities in that space because the Fed can't really be active in the private markets. And there are barriers to entry. I mean, not every investor can get access to, particularly private markets. So we still think there's a lot to do there. Let's see here. I think it's also important to, in a look forward basis, figure out, what the market's pricing in on the COVID side, because that certainly, I think, informs a lot of where the expectations are. And this is a view of the New York Times vaccine tracker that I've been using for the last couple of months, updated through last Friday. And you can see the numbers below indicate change since last month, since the last time I did this. And again, I just think, this is a really remarkable, I think, observation here, and that is science is really advancing very rapidly relative to other periods where you've got phase 3 trials of vaccines now at 11, which it was up to from just a month ago. Limited use vaccines, so the type of which I believe, or drugs, the type of which President Trump may have just had access to over the weekend. That is certainly positive to see some of these phase threes roll into the limited use stage. And then phase one, there's still a lot of companies lobbing in opportunities or drugs into the pipeline, which is good to see. They haven't necessarily given up yet on developing at least early stage treatments. So a lot of positive developments in the pipeline. So my analysis or breakdown here is that the markets are clearly expecting a vaccine announcement in early 2021. And is that a reasonable assumption? Well, I think probabilities would say that with this number of phase three as well as limited use opportunities, that we will have something, a vaccine, early in 2021. The other question, which I know a lot of people have brought up, is to what degree will they be available? Right. So availability of that vaccine, that will be probably later in the year. But I think just having some predictability around where a final treatment is going to be coming from will give the markets the needed comfort that we got this under control. So just dovetailing onto a question someone just lobbed in here. How will the economy and market fare if a safe vaccine cannot realistically be widely distributed until next summer? It's a great question, Tony. I think the answer to that is it's not going to be received very well because a lot of what you're seeing on the screen right here are estimates based on that assumption. And I'll answer your question as it relates to this slide as well too, right here. So after a challenging 2021 is expected to have, this is Goldman Sachs estimate. Consensus estimates are in blue. This is the consensus dotted line across. I think it's 49 forecasters. Goldman's at about 5.8. But you have to think that if it appears that a vaccine is not going to be widely available, or we don't find anything prior to early 21, then you have to believe that this consensus number is going to shift pretty markedly towards zero bound, because what it's going to mean is more shutdowns potentially, and more radical solutions to getting this virus under control, and that's not good for economic activity by any stretch of the imagination. So I think that revision towards a zero growth rate in 21 would suggest that that could really impact earnings for companies, broadly speaking, and that the market would have to correct a decent amount to reflect that outcome. Growth, but I think going with the highest probability scenario, though, a 4% growth rate is, let's face it, that's an above trend growth rate, which we haven't seen since 2009. So that's a nice, I think, floor or context to be working around or investing around, I guess, for that matter. And it's important to see that there are still, despite what's going on globally or in the economy right now, there are parts of, in general terms, there are parts of the economy that are doing well. I mean, for those of you that are in the housing market, you may have noticed that it is a very tight housing market. You can see here what you're seeing on the screen is the Case-Shiller Home Price Index. This is the blue line is the 10 largest markets. The red line is the 20 largest markets. And the, I guess, yellow line is the national index. And interestingly, the national index is rising faster than the top 20 or the top 10. And I think what that's reflecting is what I'm referring to is a de-urbanization here, where people are fleeing the big city suburbs, not in huge droves yet. I mean, where you can really see that right now is in New York City, for that matter, or San Francisco, but those were way expensive markets relative to the median home value. And housing is a really large segment of the economy, a single-family home market, and I think that is a positive, contributing sector right now, is really a nice, solid underpinning. And you have to juxtapose that with things that aren't working. And here we go back to that industrial economy that's really not back up to 100% quite yet. What you're seeing on the screen here is one of my favorite indicators. It's called the Chemicals Activity Barometer. It just measures the aggregate amount of chemicals flowing, through the system or through the economy, being demanded from, businesses and consumers, everything from plastics to, other, synthetics and other things. And, we haven't gotten back to this, this is the 0% line. So we're at about -2 or 3% still from where we started the year. And, it's just important to note that the cyclical parts of the economy are seeing a much less robust recovery, but this also helps inform our, where we're positioning. And I think if you, kind of back into who's really affected by slowing GDP, from a sector perspective, it's the industrial segments, of course, and also small companies. Small companies tend to have fewer product lines to rely on. They get less assistance from government programs. They also don't have access to the bond market, which is a big plus for companies like Apple. And let's move on here real quick. And these are just a few other economic indicators I wanted to touch on before we got to the positioning. And that this is, consumer spending. And this is where I was mentioning, consumer spending, as it turns out, is actually not too far off where we started, the January, February timeframe. You can see lower income folks are right back at, where they were in January and February. Middle income are off about 2 to 3 percentage points, and higher incomes are off about 10. But this is, I think this is just important to note that spending takes a lot more time to recover than it does to fall off, because people take drastic moves initially, typically when the economic situation gets cloudy, and they start to only gradually start spending more as time goes on. But this also informs potentially where we'll be positioning in the future as well. And then speaking of, some of the other questions around, quarter end issues would be, what's going to be the catalyst for, adding to European companies versus US large companies. And I think this chart just helps explain why we still have a large affinity for US large cap companies. So what you see here are two charts, or two lines. One is the S&P 500 earnings profile, earnings picture. In this dark blue line referenced to this index. This is a year-to-date picture. And then the gray line is the Euro Stoxx 600. So it's the basically S&P 600 of Europe. And what you can see is this is one reason why we haven't necessarily found a lot to do in Europe quite yet, is because, European companies got hit harder because they tend to be more industrial oriented, financial oriented, as COVID took hold. But you can also see that their recovery from an earnings perspective hasn't been nearly as robust as the S&P has, because I think the S&P has far more companies, particularly technology companies, that are less anchored to the economic cycle. Certainly every company has an anchor of some sort, but less anchored to the economic cycle than an industrial or financial. And so I think that's really helped performance for the S&P this year so far, but also helps inform why we still think the US is the preferred spot to be. This is just another look at valuations. You might hear a lot of people tell you that, international stocks relative to the US are attractive. And I would say from a valuation standpoint, that is correct in the rote sense. So what you're seeing on the screen here, I think I showed this one other time 2 months ago or so, but it's important to revisit. This is just a equally weighted composite of three of the major valuation indicators for stocks. You have price to earnings ratio, price to book, and price to cash flow. Lower valuations, to all things being equal, are better for forward-looking returns. And you can see that what this chart is telling you is that international relative to the US. So international stocks trade at, roughly a 45% discount to the US across all these metrics on average. And while that on the surface sounds good, they are cheaper, no question. There's got to be more to the analysis than just cheap, because if you just invest on cheap stocks, then you run the risk of falling into value traps, which I will touch on the next slide. Here's the value trap, and apologies to those clients in Palm Beach that I've beaten the drum on this about before, but I thought it'd just be interesting to introduce this concept to the wider audience. And that is, This is a picture showing you the price performance of the Euro Stoxx 600 bank index. This is European banks. And I think what this chart shows you is that not only are they trading at all-time lows, but it's not been a very positive ride for European financials, really since the post-GFC era. And of course, what happened during that was, Europe took emergency measures, dropped rates to negative interest rates, and created a very challenging environment for banks to operate within. But this is a picture, I think, of a classic value trap. European banks trade much cheaper to US banks. But the problem is European banks' growth is tied to a slower growing region of the world, and they haven't diversified very well by and large. And so because of that, they've got a few headwinds that are in front of them. So that's a classic value trap. They are cheap, but cheap doesn't mean good. And then this was a question that I got ahead of Market Matters here. So I just wanted to mention that a lot of you have been asking, okay, so what happens if Biden gets elected? Isn't that going to be bad for stocks? And one of my comments, I think, last Market Matters was that, isn't raising the corporate tax rate going to be, I mentioned a potential issue with the corporate tax rate being raised. So if you look at their policies, and I've looked at, Biden's programs and policies, I haven't done as thorough of a look as maybe Goldman Sachs did, but I think what the net of it is that Biden is not necessarily recommending changing the corporate tax rate or personal tax rate till well into his first term. Now, I'm assuming that Biden gets elected. If Trump gets elected, that's a different story. But I think what he's indicated is that with some of the policies that he's put forward is that he's not going to be the reason that the economy goes back into the tank. So I think you can expect a very supportive amount of government assistance, not only for those in the lower income levels, but also the modified Green New Deal that was being kicked around, and things of that nature would be pretty supportive, I think, for the aggregate economy as a whole. Whether, now I understand, there's going to be some issue with the debt issuance. So that's a whole nother separate question. And I think the way I've identified or addressed that question in the past is, the debt won't be necessarily a huge problem for the US until investors start buying our bonds and interest rates start rising at the same time that the US dollar starts to decline pretty rapidly. Recently it's only been dropping, slowly. But that's going to be the time when that you've got an issue with the debt. So my point is that I don't think Biden will be, killing the stock market anytime soon with some of the policy proposals, because a lot of those are back end loaded on the end of his first term. Sorry. So here are just some notes, which are actually going to be similar to the portfolio implementation. But I just, these are some ideas that I definitely wanted to make sure we touched on. One is that, the mainstream 60-40 portfolio breaks down with low interest rates. And so this has been a concept I've been talking about, I think, in the last few Market Matters, but we are going to have to be more creative with ways we generate income and also invest around some of this volatility that we've got ahead of us. And, I think accessing private markets for income is certainly one of the recommendations there. That's maybe uncomfortable for some folks, but it's just the plain reality that, if you're going to invest in a government bond fund right now, you're guaranteed less than 1% for 7 years. That's not a very good risk return in my estimation. I've covered a few of these other things. Also, I think the stock market has already begun to discount the U.S. presidential election outcome. You can see that coming through in some of the subsectors of the economy. So, what's been selling off a little bit recently has been defense contractors. That still continues to be the case. Pharmaceutical companies have come down a little bit too, because of fear that Obamacare Plus will be put in place by Biden. And there's a few other items like that have already started to discount this. A curveball, I will say, which there is some possibility of this, is that we get a long-term contested election. Recall that in 2000, the Gore Bush election, there was a period of about 3 weeks between the November 3rd and I think the end of the month, where the Supreme Court ultimately had to step in and say, George Bush won the election. We can use these votes and not these votes. So a longer-term contested election, longer than a few weeks, hasn't come up before. So that would be a wild card. That what's going to happen if we get one of those? Well, it's likely going to be a sideways to slightly down market, I would guess, with a lot of volatility in between. So we've got that, but that's, again, if it's an overwhelming landslide for one side or the other, then that won't be a possibility. Equity side, I think we touched on a number of different things here. But I think just to address maybe some of the concerns folks have for valuations in the US, it's important to remember a lot of companies and sectors through this whole COVID environment have been able to, as I'm calling it, pull forward 3 to 5 years of revenue into 6 months. I mean, the prime case study of that would be Zoom, which we're on today, or Peloton. They've pulled forward tons of members from LA Fitness or Planet Fitness. So their valuations, if they're growing much faster at higher revenue margins, should be generally speaking higher than the average. So that's the only point I wanted to make there. Yes, average valuations, we're a ways off from that, but we can stay at these elevated levels for a while, as long as we have some of these dynamics working in favor of the companies that are leading the market higher. Fixed income, again, that continues to be a little bit of a quandary or a little bit of a risk point, but we're addressing that. Our contention is it's going to be lower yields for now, but higher yields later as inflation shows up eventually. We will be looking to potentially reconfigure the role of bonds in a portfolio and be looking for maybe a publication on our website about what that means. We haven't necessarily decided in finality what that's going to mean as an investment committee, but it's more going to emphasize capital preservation potentially in the bond portfolio versus income generation, and then seeking income generation elsewhere in the portfolio. And then finally, I would say, I would want to mention that on the alternative side, for those clients that have alternatives in their portfolio, we are adding again positions or strategies that can benefit from higher levels of volatility. So there are things that can work when volatility goes higher. Particularly, if you look at volatility around the election, the options markets are pricing in a very wild few weeks. And we have some strategies that can benefit from that. So we think we're in a good spot. Turning to implications, I just touched on a lot of this here, but I'm going to summarize it in a few bullet points, and then I'll move to questions. Equity markets are set to generate lower positive returns over the next 10 years. There's no question about it. Valuation does inform where, future returns will go, just because, you need to find people to keep buying at higher prices. And it's going to be punctuated by sharp sell-off. So I think what the net of this is that, active management, and particularly within the equity sleeve, but again, also in other parts of the portfolio, like fixed income, are really, I think, are really set up well to do well in the foreseeable future, because you've got volatility episodes likely ahead of us, higher valuations. So differentiation, as I showed you in the sector performance, can really have a big impact on returns. We are, tactically rebalancing, and some of you have probably, that are clients, have probably noticed over the course of the summer, we trimmed back some of the growth-oriented positions and added to our dividend-driven positions, or even fixed income for that matter, and alternatives. But these small or minor adjustments are really useful to helping reduce risk. And also, volatility between asset categories, between stocks, bonds, or alternatives, just creates opportunities. So we want to be ready for that, which is what we're doing with the cash position we're starting to accumulate now. But you have to have cash on hand to be ready to act. And that's a key lesson that I took away from 2008 or 9. And that's really worked out to our favor earlier in the year, when we were able to add back to equities in March and February and March. So you've got to have some cash on hand to be able to act. And then finally, on the bond side, like I mentioned, we're looking to change the role of bonds in our portfolio potentially, or at least modify it, looking to alternative strategies for income more in the future. Even equities, our dividend strategy that we have had in place now for the better part of 8 years has a 3% yield bogey to it, which at the time we thought was adequate. Now it seems high relative to fixed income, which is great. We've been able to maintain that, but that's another kind of way to look to generate income. I hope you all enjoyed the new updated format. Like I said, we're going to be doing these in lieu of a written publication for the foreseeable future, and unless there's a really big demand for me to start doing those again. But I think this kind of presents a little easier and is a little easier to understand and digest. So any suggestions you might have on how we can improve the content, I would love to hear it. Please feel free to email me directly. If you have my email address, that's tjones@gratuscapital.com. And we look forward to seeing you again next month. So we'll talk to you then. Thanks.